lightning round. We're going to go through a few of Jeff's articles and touch on what's happening in the world economy, some recent news stories, and I'm only going to give Jeff 10 to 15 seconds to answer each question.
I didn't agree with this. Wait a minute. That's way too restrictive, and anybody who knows the show, 10 to 15 seconds, as I've just wasted 10 to 15 seconds explaining
over, Jeff.
Yeah, that's not going to work.
All right, first stop on our Commonwealth tour, we're going to go to an article you wrote for Alhambra Partners. You posted it on the September of the 2nd of the 2001, and it's called China, Australia, and the European Way into Reverse Repo. We're going to start with the Australian dollar. Jeff, I'm going to pull up a graph here, and just tell us the Australian dollar and the Chinese yuan, how it's linked.
Yeah, well, I mean, Australia is very much influenced. The Australian economy, the Australian finance system is very much influenced by what's going on in China for obvious reasons. As a resource and export-oriented economy, that makes perfect sense. And then, you know, the Australian dollar is simply tracks along with the global financial flows, as you would expect. You know, the Australian dollar gets weaker when we go into dollar shortage, rising dollar situations. It gets stronger as reflation takes over. It's a pretty consistent indicator along those lines. And what we've seen is there's that date again, February 25th of this year, peak in the Australian dollar. It's been cited backwards and going the wrong way ever since, which is deflationary, rising dollar stuff. And then that really picked up after May, and in particular, a couple days in June, the middle of June. Something happened in the Australian dollar, but not just the Australian dollar, it was the entire dollar system that registered what was not necessarily a seismic, huge earthquake, but it was serious enough that it seems to have caused a stir, certainly a disturbance in the exchange values, and then some consequences thereafter in the Chinese exchange value, which sort of matches and lines up with the Australian dollar, as you would expect, as I said.
Well, it lines up until June 18th. Jeff, that's the point that we're going to take it right now. Yes, the Australian dollar follows a certain pattern. The Chinese yuan follows that same pattern because the two economies are so closely linked to themselves as well as global capital flows. But then, June 16th, 17th, 18th, we're looking at the graph right now, the Chinese currency went straight, as in level, as in it's not changing, while the Australian dollar is falling. Jeff, before you explain that, can I just drop a bit of shocking news to you? Are you ready? We've always been talking about the 24th, 25th, and 26th of February and how everything turned around. I found another one, Jeff. It's in your graph for the Australian dollar. I found another one, the gold-silver ratio, Jeff. Now, I've always maintained that if a rising ratio signifies that gold is getting more valuable, therefore, you know, disinflationary circumstances. If the ratio is falling, silver is getting more valuable, reflationary circumstances. Jeff, I know it's easy to dismiss two lumps of metal and their relative value between each other, but the multi-year low came in on the 25th of February. And ever since then, it's been going the other way. Now, I want to do a quick footnote because people are going to say actually it came in on February 1st. That was the day where the meme stock, GameStop, Reddit, Wall Street Bets crowd focused on silver. So silver shot up in value. The next day, the ratio was back to where it had been before. So I'm striking that from the conversation. But Jeff, yet another monetary indicator that something snapped on the 24th and 25th.
We added to the list, not just because it's another it's a long list, but we added because our main theme and our main thesis is that this is not just a recent development, right? This deflationary pressures have been building for quite a very long period of time. They predate Delta, they predate, you know, the labor shortage getting really worse, all of these excuses that are thrown around for the U.S. economy, and they have had they have matching impacts in the rest of the global economies, particularly China, which explains why China and Australia would act in the way that they have, except for that latest part where they decoupled.
They decoupled on that day, that week. Why, Jeff? What happened between the 16th, 17th, and 18th of June?
Yeah, unfortunately, since this is a lightning round, we can't spend a lot of time on it. But June 17th was the rate, the day the Federal Reserve paid a 5 basis point rate on the reverse repo program, which was the Fed meeting in the middle of June. So something happened in the Fed meeting, and I believe it was the reverse repo going to 5, which exposed the collateral story. And if you want to read more about exactly what that is, you can go to our website and find that. But that's really when the reverse repo started to become that much of an issue, the Fed exposed the collateral thing, which then caused a bigger problem in the dollar system because everybody could see that it was a collateral issue, which then led the Chinese to do something with their own currency, which means stealth intervention in China, which the Australian dollar further reveals by that decoupling. So now we know that CNY is being pegged or at least put into a loose range. And today there's been all sorts of fireworks in CNY, which Maren will be able to get to. So something's going on with the Chinese currency, as I said a couple episodes ago, always makes you cringe because whenever the Chinese start to stealth-manage their currency, that's usually one of the signs that things are going the wrong way to a serious degree.
Thankfully, Philip R. Lane is on the case at the ECB. Now, this is my weakest connection to the Commonwealth because he's actually Irish and they're not a member of the Commonwealth, but Northern Ireland is. So the connection stays, ladies and gentlemen. Recently, he talked about what the ECB is going to do after their exhaustive review. Why am I bringing it up? Because it was in your article that we just mentioned with the Australian dollar. And as part of that exhaustive review, Jeff, they have decided that they are going to now do symmetric inflation targeting. And by my estimates, they're about 3 years behind the Fed, who announced this in June of 2018. And then a year or two later, in August 2020, they updated it to average inflation. And then they're about 3 or more years behind Japan, who in July 2017 had this report published, which said, why did the BOJ not achieve a 2% inflation target with a time horizon of about 2%? And then here's another one from the Federal Reserve, raising the inflation target, lessons from Japan. Quote, this is from the Federal Reserve, January 2020. The success of adopting an explicit inflation target to lower inflation in the past may not necessarily imply the success of doing so to raise inflation in the future. Symmetrical inflation, the ECB. Why are they doing it?
Because they don't know what else to do. That's the short answer. The real answer is that, look, they have no idea what's going on, and so they're thinking, well, why have we not been able to achieve an inflationary liftoff in all of the years since 2008? And in Europe, it's been the same as it has been in the United States, which is already a clue that there's a unifying global factor that has nothing to do with central banks. And central banks are simply struggling to identify cause and effect. It doesn't mean that they ever admit that there's this global unifying monetary factor beyond their control, because to admit that would destroy all of mainstream monetary thought and monetary policy and central banking in particular. So the ECB has decided, well, we'll just do what the Fed does. We'll just hope that the explanation is that when we get in these situations where the economy gets so weak, such bad recession, central banks have to interest rates fall, which means that central banks encounter the zero lower bound, which limits their ability to really lower rates as quickly and as far as they might want to, which causes them to do all these extraordinary monetary programs like quantitative easing, which everybody knows because we're all taught in the textbook is powerful monetary stimulus. And so as soon as central banks are forced into this powerful monetary stimulus at the zero lower bound, the market immediately thinks this is going to be inflationary. And because we also know that central banks are inflation fighters, that by the very fact of them doing these powerful monetary stimulus means that it's going to lead to inflation, and therefore they're going to prematurely snuff out the inflation, which means central banks, by being successful, are their own sense of failure. That's really what we're supposed to believe here.
That was amazing. That was a lightning round. Unbelievable. People
And
can,
it's all bullshit. So that's really, it was a waste of everybody's time. And I think the reason I put that into the article was this is what central bankers around the world are busy doing. This tortured logic, pretzel logic nonsense about forward guidance and symmetric inflation targets, where in actual money is that stuff with the Australian dollar. And basically the only real central bank left on the planet, which is the People's Bank of China, which at least intervenes in money occasionally, not very effectively, but at least they do. So while central bankers are off talking about ridiculous nonsense and absurdities, the actual monetary system is once again left to its own devices, which is one reason why we're stuck in this problem, because the monetary system in a deflationary environment left to its own devices will never get out of that same deflationary environment.
Deflationary environment. Jeff, I'm always mindful that whenever we talk about inflation in this time, people are going to turn the show off because they see prices rising. Natural gas, earlier it was lumber, cars, vehicles. So I want to just read a couple of lines from this story, because the point that you always make is we are not disagreeing that there are price increases. We are disagreeing that this is a result of monetary inflation, that these price increases are caused by central banks and central governments creating money and raining it down upon the economy. Let me read a story about natural gas from the UK. It's the Financial Times. Natural gas crunch sends prices hurtling higher. Natural gas prices in the UK have soared to some of the highest levels on record, threatening to raise costs for households and businesses. Why? Did they mention the Bank of England? No. Supplies of the critical fossil fuel remains tight. So the prices are the highest like since 2005, and they're at a record high for the summer. Here's some more. A prolonged winter, so they're listing the reasons why this has happened. A prolonged winter drained storage levels across Europe. Meanwhile, Russia, the largest supplier, has sent less gas to the continent than before the pandemic. Critics believe that Moscow is trying to pressure the EU to approve the launch of the controversial Nord Stream 2 pipeline later this year. But Russia has not been the only factor. Natural gas supplies have tightened globally as big economies have rebounded from the coronavirus pandemic. Here's another one. Brazilian imports of LNG have climbed to the highest on record as droughts crimp its hydropower plants. Supply has also been hit by a series of outages and planned maintenance. European domestic production has also posted sharp declines, both from the North Sea and, I can't say this word, Groningen, the continent's largest onshore gas field in the Netherlands. That field has been forced to restrict production because of a series of minor earthquakes and is now expected to shut permanently next year. The number of times Bank of England, Federal Reserve, Jay Powell were mentioned is exactly 0, Jeff.
Which
not
is
monetary inflation.
Yeah, for a mainstream media source, because they're always looking to attribute these things to positive and powerful monetary quote-unquote stimulus.
I've got another story, but I guess because it's lightning round, I can't do it. But it's about car chips, Jeff. Ningbo, the third busiest port out of China, COVID, Malaysia, a fire at the second largest automotive microchip processing factory in Japan. All of those things are the reasons that prices are so high, and why U.S. car inventories are now at their lowest level in over 50 years of data. Not once is Powell or Bernanke or Yellen or the Bank of England or the Bank of Japan mentioned. It's supply chain demand surges caused by the corona and everything. It's not caused by money printing.
Yeah, and what we're saying is that if it's not inflation, then we don't expect that it's going to last. Once these supply bottlenecks work themselves out, it will have been a transitory deviation in certain prices, which is different from monetary inflation, which is where you get into a situation, a nightmare situation like the 1970s, where no matter what people do, it just continues on and on and on forever. And I know people A lot of people out there are predicting that this is just the beginning of that, but that's what we're telling you, that it's not, because we don't see the monetary signals that would go along with this being a prolonged period of, like, the 1970s out of control prices. What we're seeing instead is reinforced data, reinforced price signals, reinforced market signals saying that this is idiosyncrasies, supply factors, government intrusions, things like that, that don't line up to something like the great inflation of the 1970s.
Our last stop on this whistle-stop tour of the Commonwealth is in the old country, Jeff. England, Britain, and the Bank of England. And they recently had, what did they have, Jeff? They had a meeting, a conference, a confab. Where? It was the House of Lords. It was actually the
House of Lords that commissioned a report.
Yes.
That said, hey, let's look at this QE business because we're not convinced it seems to be doing what it's supposed to be doing.
And it's interesting because on the one hand they get it and on the other hand they don't. And so you help us understand. It was posted on, at least the transcript here, or the summary report was published on the 16th of July, 2021.
So very recently.
Economic Affairs Committee, quantitative easing, a dangerous addiction. Why?
Yeah, it's a dangerous addiction, but addiction to who? Maybe the stock market? No, not necessarily. I think they were talking more about policymakers. Policymakers are addicted to QE in that they say, let's keep doing them one after another without ever evaluating whether or not they should be doing them at all. What the House of Lords did was present a bunch of witnesses, put together this exhaustive report, and the conclusion was, we're not really sure we should be doing this QE stuff. Number one, the only place that we could identify where it was possibly helpful was during financial crisis. What we're really saying is that we don't know if it actually helped. We just can't tell because we don't know what the crisis would have looked like if there hadn't have been a quantitative easing. We're just assuming that quantitative easing and bank reserves played some role in stopping the crisis. So that's the best that they can say about quantitative easing. And as we know around here, we don't buy that one bit anyway. But that's what they said. That's the good part of QE, is that we can't falsify it didn't work during the crisis because we don't have a counterfactual to show what it would have looked like if they never did QE. But more importantly, moving ahead, what does it do in terms of inflation and real economic growth? They all came to the same conclusion, is that it doesn't do a damn bit of anything. So the only argument in favor of QE is that it may help during crisis, but there's really no evidence for it. But as we're seeing around the rest of the world in these academic studies and various other places that the public is not clued in on, even the official verdict on QE is more and more and more negative, that this is not money printing, or at least it does not lead to the conclusion, or at least it doesn't lead to the symptoms that you would identify and associate with money printing, which, as we know here, because QE is never money printing, it's all smoke and mirrors. And so even the official world, even politicians are starting to get the idea that the promises are not lining up with the actual results, and therefore they're starting to ask questions about why they still think, you say it's easy money, you say it's money printing, and of course I'm thinking about our Frontline episode a couple months back there. You say it's easy money, but then we have to describe all these ways that it can't have been easy money. What are we missing here? And what we're missing is, maybe we don't know what QE is, but we do know we're starting to get very good data and a very good sense that at least it doesn't work. So maybe we do need to take a closer look at what it actually is.
British comedy is supposed to be understated, and the whole culture is supposed to be a stiff upper lip and keep your chin up. So I'm going to read some comments that are very pointed, coming from an understated culture. Here, quote, "The effects of quantitative easing remain poorly understood, and in recent years, particularly during the COVID-19 pandemic, the Bank of England has struggled to explain why it was the appropriate response to particular economic circumstances. While the scale of quantitative easing has increased substantially over the last decade, there has not been a corresponding increase in the Bank of England's understanding of the policy effects on the economy in the short, medium, and long term. Many market participants said that they believed the Bank of England had used QE primarily to finance the government's deficit spending. If such sentiments continue to spread, the effectiveness of the bank's policies will be threatened severely. It is needed urgent.
Already, I mean, that's a ridiculous statement, right? Because you're saying that we don't know how QE works, so how can this other thing threaten the effectiveness when we don't even, when there's substantial arguments about the effectiveness? You know, we're supposed to believe this stuff is powerful monetary stimulus, but if that was the case, the results would be self-evident, right? We wouldn't need to question it, because if you're money printing, we would see the inflation. That's really how simple this is supposed to be. And the fact that we don't ever get the inflation, despite how big these QEs have become, is a powerful indication that it is not powerful stimulus. So we keep saying all this easy money leads to non-easy money results. Maybe we need to go back and say it was never easy money in the first place. It's just a bunch of smoke and mirrors, some accounting tricks to get people to believe in the fantasy, which in the face of a real deflationary monetary shortage environment, fiction and fantasy doesn't do you much good.
Here's the last and perhaps most damning line. Needed urgently. The need for the bank to provide a way for the public and Parliament to judge the success of the program, to ensure that it can be held properly to account for its decisions. Like the things you say are supposed to happen are not happening, and we need a way to be able to tell if you're doing what you're supposed to be doing, what you're saying you're doing.
Do that, right, Emil? I mean, isn't that what you promised us this, it didn't happen. So why do we need to construct some form of measurement tool? Because we just said it didn't happen, therefore it didn't work. So why do we need to go any further than that? It's really that simple. You said this was going to lead to a recovery in inflation. We didn't get a recovery. We didn't get inflation. End of story. But no, obviously, you know, central banks are never going to accept that, and certainly politicians. It's very hard for the public to get their heads around what central bankers actually are and what they do nowadays. So this is going to be a very long and drawn out process, whose conclusion will ultimately view QE as a waste of time and as a waste of a huge cost associated with it, not inflationary cost, but with that wasted time. But that's something that's going to happen slowly over time, and won't be until long ways into the future until we can unlearn all of the stuff that we've been taught and indoctrinated into for the last 4 or 5 decades.
Jeff, this is the 3rd of September. Next time we speak, the first NFL game will have been played. And I wanted to tell you and be upfront with you that I think Mac Jones is going to be better than the quarterback in Buffalo, Josh Allen, and that I won't be rooting for the Bills this year, and that if you want to continue the show, you should let me know, but if not, I'm just being upfront.
I think it was tremendous that the Patriots selected Mac Jones, because as we know, the history of Alabama quarterbacks is exactly what we wish for the New England Patriots.
Okay. All right, well, we'll have to put some Eurodollars on the season then. Let's bet some Eurodollars, or maybe Bancors or SDRs. I can go through the limit. Since it's not real money, no problem.
We can create our own monetary system. Okay. We'll just keep a ledger, and whoever, I'll write down what you owe me, and you write down, and we'll reenact the Eurodollar from our own ground up.
Super. All right. I'll talk to you next week.
Okay, Emil. Take care.